I'm Jeremy. I am one of the co-founders of EQV, and this is my partner, Itai. Itai, say hey.
Hey, guys.
Itai is going to kind of be the this special guest finance interpreter, as he always is, and we are an alts-based RIA here in Austin, Texas. And I think with Itai, with that, I would love to turn it over to you if you want to hop into the good curriculum for the day.
Yeah, for sure. So from now on, as Jeremy said, we'll do once a month kind of a market update and just look at different economic data and try to provide some insights. And the other time we'll dig deeper into a topic as we've done in the past. So let me just start by sharing the screen and hop into it, if you can allow that.
All right. You are now free to share, my man.
Thank you so much. Let me share. So speaking of free, I've still not activated my my Microsoft Office subscription, and it's still working.
I've been getting tweets from Satya Nadella and from Bill Gates, and they're saying that their pockets are really, really hurting because one person in Central Texas is violating their rules over there.
Okay, sounds good. All right.
Okay, that was not funny. All right, I'll work on my humor.
I won't buy MSFT anymore. All right, so Equilibrium Ventures, we focus on alternative assets. Won't get you too much into the spiel on that, but we kind of believe that the way to grow portfolio is no longer through a conventional 60-40. And actually some of the stuff I'll talk about will make that apparent. So without further ado, earnings season is upon us. And it's midway. So this is actually on the earnings that are coming up this week. We're going to hear a lot from a lot of different companies into how things are going with the pandemic and how are their earnings impacted or not impacted given what's happening. So I thought it was really interesting to focus on bank earnings because I believe that the banks having control of the supply of money is one of the most important things to know about the economy in general. Wanted to start here with B of A. In general, just so you know, banks have had positive earnings relative to the expectations, and we'll dig a little deep into that. So still, they have fairly strong balance sheet. They're reporting that the economy is recovering, but at the same time, loan demand has weakened, which is interesting given the fact that money is basically free. We'll go further into that. What is the biggest driver of those earnings, you can see here in the blue at the bottom, is credit losses. So Q1 and Q2 had some significant credit losses and significantly less credit losses in this quarter. And charge-offs, which is bad debt that they've basically written away as they're never getting it back, has diminished as well to more normal levels. So this is kind of interesting to me. Don't get too confused by this chart. In general, we're just looking at the average deposits at B of A. B of A is the #1 deposit market share in the entire United States. And in light blue, it's non-interest bearing deposits. In dark blue, it's interest bearing deposit. Not to mention the average interest is like 0.08% right now. So it's not a major difference. What's interesting is, for example, corporations here, year over year, 23% more cash. Also, consumer banking, 21% more cash. Global banking, 31% more cash. The total is there's just a lot more cash in the banks in total deposits right now than there was a year ago.
And so, Itai, that makes total sense because we keep talking about how M2 grew by about 30% this year. So we're just basically seeing that going into cash deposits.
A lot of it going into cash deposits. That's right.
So it's on the sideline. So what does that tell you about the potential direction for the market?
Yeah, that's one of the things that have been driving the markets is the fact that you just have a lot of cash sitting on the sideline and that number is increasing. But at the same time, as we'll see later on, the fact it's sitting at the bank, meaning it's not necessarily getting spent, which the growth of money supply is not corresponding to a massive increase in velocity of money at all, which is interesting. Also, let's focus on this here. Even though we have a lot more deposits, the interest income the bank is making is diminished. and they're making a lot less money on these deposits. So that's an interesting phenomenon for the American banks that I want to talk about, because we've seen this before. So here is what's happened with the European banks over the past few years. Here in left, it's the European Central Bank depository rate. They went below zero here in 2016 to a negative 25 basis points. And then here on the right, the blue is the performance of the European banks versus the, I guess that's yellowish. Here in yellow is the performance of the European index. So banks do not perform well in very low interest rate environment over a long period of time. We've seen some pretty high profitability during pre-COVID when rates were going up, but right now, this is definitely something to look at because banks do not like this very low interest rate environment.
So if banks don't like a low interest rate environment, and we're foreseeing a low interest rate environment for the future to come, more or less, how might a bank's business model adapt for this type of change in interest rate environment?
Well, it forces them to do things that they wouldn't otherwise bar regulation. So like what you've seen with Deutsche Bank is they've taken a lot of derivative bets and other kind of things to make money. They're creating different kind of structured credit and try to do things that is further off from traditionally how banks make money. You actually see that with JP Morgan. So JP Morgan here, this is, they've actually smashed expectations completely. Here to the right, you can see their credit loss is down significantly from Q1 and Q2. So they're reporting very little loss on their loan book. Here's what's interesting. To the left, what you see here in these bars is that they're actually making 30 to 35% more than last year with their equities trading revenue. So they're making a lot of money on the trading side. And they're saying similar thing to Bank of America. Average deposits now up 30% year over year with JP Morgan. So
got it. So some of the comments are talking about, the future of what this means for markets in general. Alex, you're saying they do things to make money and then it blows up. Can you go on a little bit about that?
Sure. Well, it's kind of the cycle. It happens all the time, right? They back in after 2000, they dropped interest rates, and then the banks figured out, I can lend people money on these subprime things, and I can throw them into CDOs, and it's basically a curve play. You got a steep curve, so they did that, and all the while the government was cheerleading them on all the housing stuff they were doing, and guess what? Eventually it blew up. The story goes on and on. It's a big cycle. They do one thing and then they try to undo something or whatnot, and it blows up. And the banks got to make money. They want to make money. So if you put them in a situation where their normal business model isn't making nice profits, they do something else, and eventually the party is over and it blows up.
Got it. And we've seen this now a few times.
Right. So, this goes back to the idea that low interest rates appear good for a short period of time, but I look at it as kind of like an easy fix. It creates a lot of unintended consequences in multiple markets. I also found it interesting that they literally spent $525 million for legal expenses. So that's just a little side note. Okay, so going into this interest rate point, and this is something that I think is completely not just banks, but the system in total. I don't know how many here have heard about the 4% rule. It used to be common wisdom in finance up until, I guess, 10 years ago. It means that if you're retiring, you are allowed to spend 4% of your retirement account per year of retirement, because 4% is enough for that account to get replenished, and therefore you can keep that account going for the entirety of your retirement. So that was something boomers kind of grew up knowing about. And the 4% rule is completely and utterly dead. because back in the day, $1 million in retirement on 4% was enough to make a livable wage for a year at retirement. So today, given the 10-year treasury yield, and that's in a treasury, right? A safe asset that you cannot lose. So a 10-year treasury, $1 million today would give you $6,900 a year, where in 1998 would give you $56,000 a year. So in order for you today to make $50,000 a year in a 10-year treasury, you need $8.3 million, which
is absolutely insane and impossible for 99.999% of boomers.
Which, not to say that, you're literally putting $8.3 million in a safe treasury note to only make 50 grand.
Well, this also underscores the importance of social security or some other type of pension, and then if that dries up, then we just have a whole group of people that are totally screwed.
Right. Which leads to the next point, that I think we have a full-on retirement crisis ahead. And let's talk about it a little bit. So about 60% of all working age people don't own anything in a retirement account whatsoever. And this is split here in different age groups. Notice here, even the 55 to 64-year-olds, 51% of them have absolutely no retirement account at all. And those that do, the median balance is just $40,000, where we just say, hey, you need 8 million to generate 50K to treasury. Even those that are 55 to 64 that literally are about to hit retirement only have an $88,000 average in that retirement account balance. So that's pretty nuts. Also looking at it, vast majority of people, overall 60% of people literally have nothing saved up for that retirement. And 22% of those people have just less than 1 year's worth of their life in a savings account. So you can literally say that off the people that are currently going to retire soon, 55 to 64-year-olds, you probably have 13% of them that are truly ready for retirement, have more than 4x their annual expenses. So I found that statistics to be staggering, given the low interest rate environment we're in, and boomers, retiring every day now. So I think that's just crazy, and that's probably why the Fed has that third mandate we talked about.
Can we pause here for a second? I mean, I think the implications of the two slides you just covered are absolutely massive. How is this going to impact our society and even all of our personal investments?
Yeah, so I think that this is one of the main reasons we have the third mandate, that the Fed is now feeling forced to keep moving the stock market upwards, because people don't have a choice but to go into these public markets, and this is their way of getting the quote unquote appreciation versus the fixed income they used to be able to get in early 2000s, 90s, etc. With the retirement account. And that's what's happening, because we're no longer able to raise interest rates. And
so guys, what's happening at Vanguard and all this there must be some massive what are they thinking? Are they just this whole fixed income culture is gone essentially, right?
Unfortunately, it's gone. I mean, especially with treasuries and other securities. I mean, it's gone. It's been driven to zero returns.
Sorry.
But this also could be, I think, part of the wave of which drives a whole new style of investing. I mean, me and Itai have been calling for it for a while, which is that this world of alts, may make more sense. I mean, rather than going for bonds, we're trying to look for this coupon and this yield via multifamily real estate, where it's yes, there is less liquidity, but at least the coupon payments each month are, substantial enough where we can kind of make up for maybe bonds where they used to be. And I mean, the only logical conclusion I can draw here is that people aren't going to just keep flooding into treasuries. They're like, these are worthless now. You have to go somewhere else.
Yeah.
Yeah, the only issue is, alternative investments in historically are hard to access, and they're not liquid, and there are other issues with them. So the problem is we're creating very large systemic risk in the system right now, to Alex's point. So in combination with everything, just this is an interesting chart that I found. In blue is the 10-year treasury yield. You see here, it's never been lower. And then here in yellow, it's the federal funds rate. And now it's back to zero again after it's gone up. And this is the language the Fed has used in all these FOMC meetings going back through the years. Exceptionally low for some time, extended time. Then they say mid 2013, late 2014, mid 2015. It's always further down the road. And even when they start raising interest rates, they talk about gradual increases, will be patient, nothing significant. And then, of course, COVID and back to zero. So the Fed has totally changed their tone since the financial crisis, and they're extremely careful with the markets and how aggressive they go on raising interest rates. And I think that's going to continue for some time. You can see here, this is the total public debt as a percent of our GDP. And you can see what happened here during COVID. We went from about 100% debt to GDP to 135% debt to GDP instantly. So the question is, how can you raise interest rates if you're literally going to cause the US government to default? The answer is you probably can't. And it creates a lot of problems for the banks because their traditional business model doesn't work. And it's creating a lot of problems for boomers retiring because their historical places where they can get fixed income for retirement are basically gone.
Itai, I do want to pause here real quick. I know we covered a lot so far. Does anybody have any questions that they want to talk through real quick?
Yeah, I just wanted to say, do you guys feel any regulatory or pressure from the mutual fund industry towards doing getting more alternatives or fixing this? Because this is unsustainable, right?
We're asked a lot about how can you find me yield? And I think what's interesting is that people that historically were more risk averse and didn't want to take risk are now sort of forced to step up and go somewhere riskier to get the same yield that they were able to get before without risk. If that answers.
I've got a question. Are there any large fiat currencies that are not experiencing this type of situation?
Not that I know of.
Right, because it almost seems like, you need a stock split, if you will. The whole world, everyone needs to print double the amount of money and be back even or something.
Right.
Well,
No,
Larry, weren't you paying attention to the thing called the Noble that takes care of all this?
The Noble.
Yes.
we talked about it in the last call.
Oh, I was out of, I missed the last call.
See what happens when you miss a class, you slow everyone down.
Well, I will shut up, and tomorrow morning I'll look at the tape.
We'll send it. We'll send it your way.
I got it.
So
Yeah,
the
sorry.
question you're leading to is, what do we do?
Right.
So that's a question, Itai, that comes from my dad, who fits into this world of, being a boomer. He's sitting here on his portfolio. What the hell should he do?
Yeah, I think this is where portfolios should gain more alternative assets. So there are ways to make return that is not necessarily the traditional bonds, and that could be what we do with multifamily real estate. There's also private credit where lenders that don't necessarily some borrowers need access to short-term credit, like small businesses and other kind of things, and they go on more alternative credit platforms where you can still get 6 to 8% and diversify over hundreds and thousands of loans. And in general, large endowments and family offices, like even the Yale and Harvard endowment, some large family offices are now 50 to 60% of their assets actually in this alternative space, and they're no longer in the public markets as a result of all the things we're covering right now.
I have a question.
Sure.
When you say alternatives, do you also mean uncorrelated with the market?
So by nature, some of those alternatives are not correlated with the market, or they have different different risk criteria versus the market. But yes, like some of those asset-backed lending, for example, is not necessarily correlated with the normal market because they're more into a cyclical, like certain business, a certain business cycle. Some small businesses move in, with tech or anti-cyclical. So yeah, I mean, you could definitely have some that are not correlated.
Got it. Alex wrote down that private credit's been the rage for the past 5 to 10 years. So my question is, if interest rates are going to zero and the banks are getting out of traditional loans and somebody's there eating their lunch, what core business is even left for banks if what they used to count on really is being under siege on all directions?
Well, I think that's probably why you now have a 1.4 quadrillion derivatives market.
Okay, can you explain that a little bit? Because I think we've all heard of this massive derivatives market that none of us understand except people like you. Why is this important? How does this impact us and our portfolios?
Well, they just try to find other ways of making money, and a lot of the ways to do it is to write CDS and create a large OTC market where they can trade anything and everything with counterparties to create different business revenues. And it potentially can create a lot of leverage and problems in the system, just like it did in 08, 09. But now the CDS markets are on different things potentially, and some of those things are not underwriting. The underwriting on it is not as good, but nonetheless, this is essentially one of the things they do to come up with other sources of business revenue.
Got it.
All good here? Cool. So we talked about that. They can't really raise rates anymore. So I wanted to talk about what is driving the stock market today. That was more in a macro factor and what the recovery is looking like. And all this debt. So we talked about this huge amount of debt in QE that was injected into the economy, but debt is actually doing something. So I'm moving to a new house next month, and we went furniture shopping this weekend, and it's like, okay, it's kind of expensive, $10,000 for a bunch of furniture. But then they say, but wait, you don't have to pay anything until 60 days after you move in. And even when you do, 0% rate for 60 months, which comes up to like $90 a month. I'm like, wow, welcome to America. This is insane. So
unbelievable.
It's no surprise that if that's the terms, the Fed has lowered rates to zero. So some of these companies can afford to do that. And as a result, we've seen retail sales actually make a new high and recovered massively and expanded in September by greater than 50%. And
so is this saying that literally retail sales have never been higher than they ever have been?
That is correct.
But where? You and I both know that all these stores are shut down. Like that would have to tell me that online sales have just gone absolutely bananas and are now 30, 40% of all spending.
Which is my next slide.
Yeah, e-commerce. Mm.
Which is my next slide. But the recovery is all across the board. So here to the left, you can see this is retail sales ex autos are way up there. And I think the 0% rate is fueling this like no other. Motor vehicles. So for those of you that have participated in the calls for quite some time, in March or April, I think we had a call and I said, one of the things I look at is actually vehicle sales, because that's a good indicator. If people are willing to go and buy a car, that's a pretty big expense. And I wanted to see how quickly that actually recovers. See, in 07, 08, it didn't really recover. It took a long time, a couple of years almost, where here the recovery is instant and vehicle sales have actually never been higher. Even here, gasoline stations, they're haven't recovered as much, but they have recovered some. And that's primarily because a lot of people are still working remotely. And this brings our next point. Non-store retailers, never seen anything close to that. This is a huge increase, going
Yes.
from
Just kidding.
65 billion to 85 billion, 20 billion more. And what's interesting to me too is we're seeing a big shift to single family homes and back to the suburbs. We've covered this. And this is clearly evident here in housing related retail sales. Look at this here in September. This is building materials, garden equipment, furniture, home furnishing stores. This is pretty wild, reflecting a big move of people back to houses.
Yeah, and I think you and me both moving into single family houses within the next 2 weeks are perfect examples. And I can tell you, having gone to Home Depot every freaking day, that a lot of people are buying stuff because they are telling me, I've never been busier. I'm back ordered 3 to 6 months on furniture and other stuff. I am literally buying appliances 2 months out just so that they can be delivered, they can be delivered by the time I move in.
And 0% rate for 24 months is helping.
So Itai also hasn't people's savings rates gone up during the last so many months?
Yeah, they have actually. Yeah, but now it's coming down sharply. Now it's coming down again. And again, I think a big part of this boom is completely debt driven because there's access to 0% and all these stores are willing to finance. And the credit required to finance has also dropped. So who knows what that's going to do 6, 12, 18 months down the line. Even food places have recovered somewhat. And what's also interesting, TSA travel in airports passed the 1 million for the first time since COVID started. Still nowhere near the 2.5 million travels last year, but some kind of recovery.
I can also tell you too that this airport traveler index is actually roughly related to people also driving and parking downtown. I know this coming from the parking world, but I have heard that the two graphs are relatively closely correlated too, for anybody that is curious about that.
Why are they the two correlated again?
Yeah, what does that mean? Tell me what that means.
Maybe it's not that they're correlated per se, but some of the parking companies that I know are finding that they are a few points ahead of this total people checking in at TSA traveler stops. So it's basically wherever this is, parking slightly higher versus what it was. So if this is 40% of where it was, the parking industry might be 50%
That's because you wrote that parking app, and you're talking about like when you park at the remote parking at the airport.
There in city downtowns, a lot of the air travel is also business. So I'm sure there's a lot of people that drive into city downtown. So I could potentially see that correlation between the business traveler and the business commuter.
Good to know.
Sorry, Itai, can you quickly click back in the food services chart again, Brian says?
Sure.
Yeah.
You had a question about that?
Ryan? You see?
He lost his turn there. He'll get to go home and cry and think about how he could have done this one again next time.
By the way, why is this not recovered fully? Like people are just not eating at home? Eating at home, right?
I think a lot of places are still closed and not at capacity. So
people still have to eat, right? So all that gap means.
Well, this is restaurants. So this is this is not the convenient. This is not like an HEB or a Ralph, or this is not a chain store. It's an actual restaurant.
Oh yeah, I just read the sorry guys. I actually read the title. Sorry.
No worries. So why are retail sales so important? So I correlated these two charts, the Wilshire 5000 total stock market versus cumulative consumption. So remember, our economy is 70% consumption.
I'm on a Zoom call.
Tori, can you
But I had
please
to charge.
mute yourself? Tori, mute yourself.
Yeah.
No, let him talk. He's about to say something interesting.
He was. It sounded like he was going to
Like,
say.
I'm on a Zoom call. We'll do this. Hey, we're going to do. Oh, wait, hold on.
I don't know what kind of backroom dealing he was doing, but
Sounded pretty big though. No, that sounds like a big deal.
So let's go back into it. So consumption, 70% of the U.S. economy. Here is the cumulative retail consumption in blue, and here going all the way back to 1990. And here in red is the total stock market. Recessions are shaded. So besides 2000 was interesting because there was just a dot-com bubble going on, and it's fairly correlated. So you can see a very quick recovery in consumption has also led to a very quick recovery in the stock market. So it's one of the things I follow for that reason, given the importance of retail sales. Even if it's fueled by 0% rate, that doesn't mean it can't last for a long time. All right, cool. Also, want to talk very quickly about what Jeremy mentioned before, M2. So money supply is off the charts. I think it's up a greater than 25% this year alone. But the velocity of money, and that concept, I explained it before in a different call, but I'll give you a quick reminder. Imagine you have $100 and then you spend that $100. How many times does that original $100 get circulated into the economy? So if I go to a restaurant and I spend $100 and the server gets some portion of that $100 and it becomes his salary, and then he goes to the repairman for his car and spends it again, how many times does that original money get circulated into the economy? So that's a good measurement to see how much of this money is actually out there in the real economy doing things. So that's not a large chunk, because you can see the velocity of money is actually down significantly. And if we go back to the beginning of the call, we're seeing, B of A deposits up 30% for the year and JP Morgan and all that story. So it's telling us that that money is not necessarily ending up in the real economy at all.
Itai, two quick questions. First is the ratio here, because it looks like the velocity of money at one point in the mid 90s was 2.2. So that means every $100 is being circulated 2.2 times?
That's right.
So now we're closer to flat one, correct?
Yes.
Why is it, what are the implications for a healthy market? Like, why is a high velocity of money so important? And why are you starting to get scared now that it's falling off a cliff?
Well, it's just telling you that there's a lot of the money that's being used, whatever it is just being circulated a lot. And there's a healthy lending going on in the market. There's healthy participation in the market. Having a very low velocity of money tells me that the majority of the money is concentrated with very few people and corporations versus more broadly distributed. So imagine if only the 1% of the richest people had access to this money, they would just buy stocks, real estate, bonds, and other financial assets versus going into the economy in general, which is also one of the reasons that you're not seeing inflation with so much money printing. Because if you're a wealthy individual, for example, if you have more access to money, you're not going to go and buy 20 meals a day, because if you bought 20 meals a day, there'd be a higher velocity of money. No, you're going to still buy 3 meals a day. Maybe they'll be nicer, but they're not going to be the equivalent of 20 meals a day. And the remaining of the money that you have, you're just going to go and buy more stocks with, right? Which is why you're seeing what you're seeing in the markets, and you're not seeing actual inflation.
So you think that protects us from inflation more generally? Just ish?
I mean, this is why you're not seeing classic inflation like you saw in the 70s and 80s, but you're actually seeing asset price inflation, right? Because you're seeing real estate go up and stocks go up. So
it's only going to a few people. And if that money's not getting invested, that's just being put on the sidelines until some wealthy person decides to go and buy a building or decides to buy an asset, and thus driving that asset price up.
Right. So not everybody has equal access to the new money. And that's one of the reasons, there's a lot more money in circulation today, but the same amount of people are using the money. So that's why velocity of money is sinking.
So if let's just say if rather than being at a 1.1 ratio today, we were at a 2.2 ratio. You're saying at a 2.2, we would actually see inflation of everyday goods. Wouldn't that be terrible for us right now?
Well, that would cause the Fed to raise interest rates and balance it off, and then you'll see a 4 or 5% Treasury rate. So not necessarily, and then they will halt the new issuance of money and they'll control it.
So the velocity of money is more tied to the demand for money and the interest rates, and so it going up naturally is more of the natural market saying, "Hey, we want money, give us a return and a value to it."
Right. There's also, so when velocity of money was too high here in the late 90s, what did the Fed do? The Fed raised interest rates aggressively at that time. That's eventually what popped the dot-com bubble. But that's a different.
That's another thing. And we got a question from Mike. Mike, if you're on, do you want to share that?
Yeah, sir. And this might be a bad question, but does the emergence of alternatives and the increase in like private equity, venture capital, and other liquid investments impact the velocity of money? And those trends we've seen over the years, or is there not a correlation there?
Yeah, I think it's a fair point, because some people, again, with access to cheap money are taking that and putting it again in assets, which creates asset price inflation because they have access to all this minted money that you're seeing here. But then that's a part of the story. It contributes to the asset inflation, but not everyday inflation. This is literally why people ask me all the time, like, we're seeing so much money printing, why aren't we seeing inflation? And this literally is the reason.
Cool, thanks.
Thank you.
Sure. So I want to talk a little bit about the labor market too, as a part of our update. I think that's a little interesting. We're also seeing a big recovery in employment. So the unemployment rate peaked around 15%, now down to 8.4, and continuous claims, even though the last one was a little bit up, fairly stabilized. It is interesting to note California, which we're seeing some very interesting things happening there. This is California's average claims versus the entire US claims to see if California is doing better or worse than the US. And now it's done the worst in history relative to the US. And that's interesting to note. You can see here the changes in claims by states. That's California versus everybody else. Huge, 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 huge change. So California, Texas is the next one. California is by a factor of more than 4 or 5 through Texas.
And the reason why Texas is second is because all the people in California are moving to Texas, then making their claims.
Possibly.
Actually, it could be the case. So why are we seeing such an exponent? Like the populations are only 25% different between both states. Why is there so much more happening in California?
So this is an interesting thing. I actually dug into it to see the reason when I was looking at the employment number. So the biggest portion that was growing. So you can see actually you have regular state claims. That's actually been dropping since April in red. And you have this pandemic unemployment insurance, and that's increased substantially. As you can see, even though the state claims continue to drop, the green portion, which is pandemic unemployment insurance, keeps growing. And the reason is fraud. So Bloomberg reported between mid-August and September in California, more than 524,000 people applied for this pandemic relief kind of thing, because it seems there was absolutely no scrutiny and no testing of it whatsoever in the state. They were just giving checks away. But once they started taking action to deter scammers and just review the application dropped to 145,000. They declined actually a stunning 72%. And right now, the entire labor markets are frozen in the analytics of what's actually going on because of all this mess in California, not actually knowing how many were true claims versus non-true claims. So the Labor Department is reported that more than 6 million Californians were claiming for this pandemic insurance, where the state reported only 2 million. And you could literally see here in the data, 6 million spread versus the federal. less than 2 in the state, and nobody knows exactly what's going on.
California, a symbol of leadership for the country.
Right. And you can see here also the state unemployment record. They're only reporting 1.7 million, where the federal reports 6 million. Some say there's some kind of backlog in the computers, or Bloomberg suspects there's massive fraud because there's been absolutely no checks in California to get the checks. Check to get the check. Get it. All right. Lastly, I want to talk about the elections, since I believe our next call is going to be a day before the elections. So one of the most interesting things is when money managers at this Merrill Lynch survey were asked, do you believe the U.S. elections will be contested? The vast majority, almost 70%, said yes, it probably will be contested by one or both sides, whoever the losing side is going to be. And you can actually see that in the VIX implied futures right now. We talked about it in the past, but it's very pronounced. So for those of you that thought 2016's volatility was stressed, here's that 2016 VIX future fly. So this is a measurement of the stress of those specific contracts. This is 2016. This is versus today. Came off a little bit, but it's still extremely elevated compared to 2016. So it's either going to come off sharply, or it's basically already pricing in that the markets truly believe that it will be a contested election, that we won't know the result for quite some time. And this is, so looking into it, the mail-in ballots probably play a big part in it, where I think almost 30 or 40% of people say they do expect to vote by mail. So these states, battleground states, Arizona, Georgia, Minnesota, Nevada, will check the ballots when they get them. All of these ones will check them before Election Day. Florida, it's a big one, Iowa, North Carolina. And 2 states, Wisconsin and Pennsylvania, also swing states, will only look at ballots, mail-in ballots on Election Day and onwards. So it just potentially is going to create a really interesting November.
And one thing that has been the most accurate foretelling of a presidential election, that Gallup, who actually stopped doing, hardcore presidential election stuff in 2012, they've been asking a question that basically says, who do you think your neighbors are going to vote for? Not who they're voting for, but who their neighbors are. And right now, Trump's leading that with 56%, and that's been actually the most accurate forecaster of any of the questions they've asked since 1996. It's predicted all 6 elections or whatever since then. Just thought that was just an interesting stat to see if it plays out this time.
What I'm curious about, Rob, is in the past, when they have the actual percentage of people, you said like Trump has 56%. When they did it in the last election, do you have any idea what the percentages were at that time? Was it reflected?
I know it's higher now. I know this is the highest it's been, because it's also kind of correlates that, are you better off than you were 4 years ago? And 56% of the people say yes. But I know that they said it's the highest it's been, so it had to have been less, obviously, than 56%. It doesn't mean it's 56-44. It could be 56-38 or something. But when they ask people who your neighbor's voting for, because they figure about 11% of people are what's called silent Trump supporters. They're not going to tell a pollster. They're not going to. I have a neighbor who puts his signs out in the yard and takes them down every night because he doesn't want to get his car keyed. He doesn't want to get his house vandalized. So he puts the signs out during the day. Most neighbors don't, and it's for the very same reasons. And I'm not saying he's going to win, but just saying that that's one of the, what will happen is when the election is done, we'll all be able to look back, and Equi will have all these charts saying this is why they won. Either Biden had all this support, or there was this silent Trump voters that said, we're not going to tell anybody anything because we're going to get we can get fired from our jobs. People are going to harass us. So you're not going to be able to get accurate measurements. But when it's done, we'll know, and then it will seem like really clear at the time. But that's just one.
I have some pretty good statistics on all that. I just don't want to open this to too much politics.
That's not. I didn't make a political statement. I didn't.
No, I'm aware. I'm aware. I was.
I
Just,
have one. I have one political
I know
joke tonight, but that's different.
I know how sensitive everything is right now for a lot of people, and I was just trying to be a little careful. But I do have.
The one thing I agree on, everybody here on this call, we're all part of the Green Party, and Green being the money party. Okay.
So we can, if there was demand, we can show some of the real stats of how the election could or may look like on the next call, which is November 2nd.